Hey, Nate here, and before we start the show, I just wanted to ask for a quick appeal. If you could give us a review on iTunes or any other podcasting service, it would be greatly appreciated. It goes a long way to helping us achieve our goals. Thanks so much. Now on to the show.
Are you looking to sharpen your budgeting skills? You're in the right place. Welcome to the Budget Couple Podcast, where we talk about life, family, and how to afford it. And now, the Budget Couple themselves, Nate and Danielle.
Welcome to the Budget Couple Podcast. I'm Nate.
And I'm Danielle.
And this week, and for the next week or two, we're going to actually be talking about retirement. We're going to discuss the different retirement options that are available for you, along with our personal finance and kind of retirement plan. Now, before we really go into this, we are not financial advisors. We are not certified or anything like that. We're sharing our knowledge and our personal investment strategy, but you need to research and do your own work to figure out what works for you and your family. We're just sharing our personal experience, and our experience is our own.
So what we're gonna start with is basically breaking it down for you when it comes to before taxes and after taxes. So we're going to talk about how to save for retirement, both by doing tax deferred options and then also saving after taxes, but not paying taxes on the gain on that. So we'll go into a little more detail with it soon.
Right. And the big thing with retirement, before we get into any discussion about taxes and the specifics of different plans, is that retirement is a long-term game. The money that you're investing now, you shouldn't be touching for most likely decades, depending on where you're at in your life. So we're both in our 30s, and we don't plan on touching the money we're investing till we're about 65-ish or so. Maybe a little sooner, maybe not, but 65 is kind of the goal to get to. I know Danielle would like to go sooner than that, but
I'd like to retire a little earlier.
We'll see what happens there with that. And we really also want to stress that if you do not have money to invest, don't invest. Pay off your debts, do whatever you need to do, but do not invest money if you don't have room in your budget for it.
And the idea with that is you wanna be paying down all of your debts aside from your house, and we'll go into that later. But you don't want all those extra dollars out there that you could be investing. So what you want to do is get rid of them as quickly as possible instead of paying interest on loans or anything like that. And then you have even more money earlier on to put into retirement.
And a good rule of thumb with stock market investments, which is the vehicle that we're going to talk about for most of the things, is that your money theoretically is going to double every 6 to 7 years on average. Some people call this the rule of 72 because 6 years is the same as 72 months. But in general, your money should double every 6 to 7 years, which is fantastic, especially when you start that ball rolling and continue it rolling. It will do amazing things for you.
So we're going to jump in now and start talking about ways you can save for retirement before taxes. So these would be things like your 401k at work, your 403b maybe. There's different options that we'll go into, but these types of retirement accounts, they come out before taxes, and you'll see them come out on your paycheck. You probably know what we're talking about. And basically, they lower your taxable income. So they make it so you don't have to pay as much taxes when it comes that time of year. So Nate's going to talk a little bit about some of the options that you might have at work.
There's really three main ones. Now, there's a ton of others. There's simple IRAs and all kinds of other stuff. I'm not going to talk about those. I'm going to talk about the ones that I'm personally familiar with, and that is a 401k, a 403b, or a 457b. Now, those break down a little differently here. A 401k is by a for-profit employer. The vast majority of companies offer 401ks. Depending on the size of your company, they may not. If you're working for a really small business, most likely they're not going to. But there are other options for you. The second one is a 403b. This is essentially the exact same thing as a 401k. The only difference is that it's offered by nonprofits. So I, as a teacher, I work for a nonprofit because it's a public education place, and I could invest into a 403b. I do not have the option of investing into a 401k. The same also goes for a 457b. That's for government, state, and local employees. It's the same thing again as a 401k. It's just a subsect for those different types of employees. Now, when we're talking about a 401k, there's a couple of rules that come into place. You can invest a maximum of $18,000 a year per person. So if I was working for a for-profit company and Danielle was working for a for-profit company, we could each theoretically invest $18,000 a year into our 401k. Neither one of us have a 401k and neither one of us invest $18,000. But that's the max you can contribute for the year. Now, once you reach age 50, there's a couple of little bonuses that come into place. You can do what's called catch-up contributions. So if you didn't max out things when you were younger, you can start making up some of that money. And that's a maximum of $6,000 a year. And that applies for a 401k, a 403b, and a 457b.
So you do want to check with your HR department at your place of employment. So sometimes your employer will match the contributions that you put into these before tax retirement accounts. Mine personally, I'm at a nonprofit. So Nate was talking about 403Bs. I'm in a 403B. My company actually puts in about 6 to 7% of my income automatically. I actually don't have to do anything. I don't have to contribute for that.
It's wonderful.
It's very nice. Now I do contribute a bit of my own voluntarily, and we'll talk more about that later. But basically, you want to check with your employer, because if they do a matching system that forces you to contribute that same amount, then you might want to go ahead and do that, even if you'd rather invest elsewhere, because it's free money. So basically, if they invested 6% for you, but they also require you to match that at 6%, it's a good idea to do that. Again, your company is giving you free money. So it's a great way to guarantee that there's growth there.
Yeah, I mean, if that example of 6%, if you are, let's say, investing $500 a month, and that's your 6%, that means your company's also investing $500 a month, which means you're doubling your retirement automatically just by doing it. So you really want to take a look and see if your company offers a match, and if they do, what that match is for. Some companies do 1%. I've even heard of companies doing like 8 or 9%. It's rare, but it's awesome, and it's really just a matter of where it's at. Now, we'll talk about our personal investment strategy later down the road. We would highly recommend that you go through and at least match. You can always max out and do other things later, but at least try to match if that's an option for you. I look at it as guaranteed growth. No matter what the market's doing, if you're investing 6% and your company matches 6%, you doubled your growth automatically. Even if the market tanks, you're still getting that money. It might not be doing much and it might lose value, but overall, that upward trend is going to continue.
So when it comes to these retirement accounts, you can't take the money out until you're 59 and a half years old. If you do have to take it out for whatever reason, I believe this goes from employer to employer, but there's a 10% penalty plus the taxes you would owe on that amount. And your company will probably have some path for you to kind of pay that money back into your account.
All right, so let's now talk about some of the pros of 401k, 403b, 457b, whatever you're doing that is a tax-deferred method of retirement savings. The pro is that you bring your taxable yearly income down. It could potentially drop you a tax bracket. So if you're at a 35% tax bracket, it could potentially drop you to a 25% tax bracket, which means you save 10% in taxes, which is awesome. It's a fantastic tool. The con is that money eventually is going to have to be made up. They will tax it at some point. No matter what, it's going to get taxed. So if you put all of the money into your retirement plan, and let's say you invest at $50,000 and it grows to $500,000, you're not paying taxes on that $50,000. You're now paying taxes on that $500,000. So your tax hit later down the road is potentially much greater. Even though you're probably in a lower tax bracket down the road, you're still getting hit. You're getting taxed on more overall money, which means you're paying out more overall money in the long term. Depending on where you're at, that may or may not matter. We're trying to set up our system so it doesn't, but it may be something to think about.
So now we're going to wrap that up and we're going to move on to some of your options after taxes. So after taxes are not going to lower your income, your taxable income, but they have other benefits. So your main option is called a Roth IRA. And the maximum you can contribute each year to a Roth IRA is $5,500. Once you get 50 years older or greater, they have a benefit for you so you can kind of catch up, and they allow you to contribute $6,500 a year. Now, it does get maxed out where you get to a point where your income is so great that they don't actually allow you to contribute to a Roth IRA. It doesn't get there until married filing jointly. You get up to $186,000 for your yearly income. We are not anywhere near there yet, so we're not worried about it. But if that's a concern for you, it's something to think about because you actually can't contribute to a Roth IRA if you make more than that. For single folks, I think it's around 120. I'm not positive, though. It would be something we'd have to look up. So again, one of the cons of this is that it's after taxes, so it's not lowering your taxable income at all. But the huge, massive pro for this is that all of your contributions and earnings are completely tax-free at retirement age, at 59 and a half years old. So you can throw money into this after taxes, and all of that contribution, all of that gain is completely tax-free.
Right. Going back to the example from before, if I invested $50,000 and it grew to $500,000, I now get to withdraw $500,000 completely tax-free, which is phenomenal. Now, you're probably not going to be withdrawing all $500,000 at once, but even if you, let's say I need $100,000 this year and next year I only need $20,000, you get that exact amount. There's no taxes, no questions. You just get what it is.
So what you should really be doing is probably a mixture of both of those things. Maybe you have a Roth IRA open, and maybe you also have a 403b or a 401k with your work. You're kind of diversifying things and hedging your bets, basically. And that's actually what we're going to be talking about here next. We're going to talk about some of your investment options. Now, everyone has probably seen when they meet with their retirement people at work, or when they get their portfolio at work, they know that they have a whole bunch of options to choose from when it comes to stocks and bonds. And we're going to just go into a little bit of detail, not a ton, on some of the considerations and options for you.
Okay, so the first thing you want to do is you want to take a look at the performance of whatever fund you are investing into. We do our investing, or at least for the Roth that I have, through Vanguard, and you can take a look at their funds. But T. Rowe Price has them. There's just tons of them out there. You can look up a ton of different banks, a ton of different investment firms, and they will kind of walk you through the same steps. But you want to look at the performance. How did it do this year? How did it do last year? What's its performance in the past 5 years, 10 years, since it was been around? You really want to take a look and find out what is going to work best, what has a good track record, so that you know that it's worth investing and that you can kind of count on that being there. Because the only thing that we have to go on with anything is past performance. So if it's been a good past performer, chances are it will continue to be a good performer. Our personal suggestion is to find something that's been around for at least 10 years and has a good track record. Overall return rate of somewhere around 10% in that time is something that you're looking for. Year-to-date stuff, ignore that. It might be terrible because year-to-date, especially depending on where you're at in the year, is very, very dependent on how the stock market's doing. So if you look year-to-date and it's January and the stock market went down a few points that day, the year-to-date returns are going to be terrible. So don't look at that. It's just good to kind of have an idea of how your funds are doing over time, and maybe particularly during a certain year. But overall, that's not a performance factor that I would look at.
Another big consideration is the fees. So you want to look at something called expense ratios, and they'll usually be in the same area where all that performance information is at. So you want to look for something below the 0.3% range. Usually you'll find stuff around that 0.1, 0.2 range for any of the passive funds, and we'll talk a little bit more about this in a second. But you'll find a whole lot of good options that are even below the 0.1% range. So you want to keep those expense ratios as low as possible because you don't want to be giving out your money if you don't have to, basically. And essentially what these fees are just it's a fee for the company that's trading these stocks and bonds for you. Now, if you're actively trading stocks, like individual stocks yourself, then or as part of a company, then it can get a little bit higher. And typical expense ratios can go up to 2% when it comes to those more actively traded organizations.
And there is an organization out there called Morningstar, which does a rating system, so you can kind of see how different funds are doing over time and what they're rated. It's a good kind of dipstick just to see where things are at. You can take it with a grain of salt as well, but it's a good way to kind of figure out what's going on.
So we're going to start here with mutual funds, and this is probably where you'll be investing. This is typically what you'll find in your employer's plans that you get, and these are passively traded. So these are not something you have to be looking up at the stock market every day and figuring out which stocks you want to trade. This is just passive. These are traded usually by computer, actually. So we're going to go through a couple of the options. You have money market accounts. You have bonds, you have target funds, you have stocks, international, and then specific sectors. So to start off with money market.
So to start with money market, they're basically just owning a group of stocks that you are mutually invested in. So mutual funds are groups of stocks that you invest in with a bunch of other people, and collectively you own them. So buying like a share of Apple by itself is incredibly expensive. Buying a share of Tesla or something like that, incredibly expensive by itself. I think one share of Tesla is about $1,000 right now, which most people aren't going to buy just a single share of a stock. It's incredibly expensive to do. So what you do is you buy parts of stocks and you spread it out over a bunch of different companies. And a bunch of people do this, and you mutually own those stocks together, and then you can sell off your share of that later down the road. On average, since 1926, the stock market has averaged a rate of return of about 10%. So, in general, you can expect your growth to be about 10% a year, which is phenomenal.
And then your next option is bonds. And bonds are a bit more conservative. So you'll generally see much lower returns with these, but they're also a little bit more secure. They're not as volatile. You'll generally see returns around 5 or 6%, or even possibly lower than that.
The next one is a target fund. And a target fund is a set of when you want to retire. So if we set the target date of 2040, that's when we want to retire. The fund is set up to invest aggressively into more risky stocks and to really go at and try to get growth early on. And as you get closer and closer to retirement age, the investing becomes more and more conservative so that your money is less at risk. And at the end of the day, you should be there and have the money that you wanted to have when you retire.
So there's three main types of stocks that we'll go over. There's the large cap, the mid cap, and the small cap. So generally, the small caps are a little bit more volatile. They maybe don't have quite as long of a track record as some of the larger caps. So maybe they've only been around for, say, 8 years or something. And the large caps have been around for 30 years. So there's a little bit more tried and true nature to the large caps, whereas the small caps actually might have some smaller companies, some upstart companies that don't have that track record but are doing really well. So it's kind of a risk type of scenario. How much risk do you want to put into this? So that's generally the difference between the large, mid, and small cap. And then beyond that, you have international stocks. And this tends to help diversify your whole portfolio. So instead of putting everything into US-based funds or stocks, you put a little bit into the international realm as well. And then to wrap it up, you have quite a few different specific sectors. And this would be things like healthcare or real estate or energy. So if you care about a certain sector or really feel like betting in that area, then it might be good to throw one of those in if you're interested.
You can also invest in things you believe in. So if you're somebody who really believes in green energy, you could buy shares of green energy stock and have that be invested for your stuff. There's tons of options, like literally thousands of options out there. And it's a really confusing world if you let it be, but you're really just looking for the type of fund it is, its average rate of return, and that it's been around for about 10 years. And that will bring down the choices very quickly, because some funds only exist for a few years and they go away, or some funds are only there for a little bit of time and they're not proven enough to really invest in.
So the last thing we're going to talk about is just something called an ETF. So if you want something a little bit more actively traded, there's these things called exchange traded funds. They're very similar to mutual funds, but again, they allow for a little more active trading. And I will actually just use Vanguard's quote for this. It's a really good explanation of what an ETF is. It's built like a mutual fund, but trades like an individual stock.
So what that really means is that mutual funds generally, again, we mutually own them and we let computers and we let people just kind of manage what's going on. We don't actively really do much. It just kind of does its thing. Whereas an individual stock, usually if you're a stock trader, you're buying, selling, you have a little bit more fluidity in what you're doing. And ETF allows you to have a little bit more fluidity, but you're still mutually invested with another group of people. So it minimizes the risk a little bit, but also gives you a little bit more flexibility as well. So on our next show, we're actually going to talk about our personal strategy for how we're investing into our retirement, what we have in there, and all of that. That will be 2 Fridays from now. But for right now, I think we've taken up enough of your time, and we kind of wanted to move on to something else. So next week, we'll be back with our strategy and how all of that goes and what our actual numbers are and where we project to be by the time we retire. And remember, you can always check out our website, budgetcouple.com, and you can see the show notes for this site along with links to all of the information that we talked about at budgetcouple.com/episode 6.
Thanks for joining us. We'll see you next time.
Thank you so much for listening to this episode of the Budget Couple Podcast with your hosts, Nate and Danielle. For more great content and to stay up to date, visit budgetcouple.com. Make sure to check out the next episode of the Budget Couple Podcast, where we'll talk more about life, family, and how to afford it. We'll catch you next time.